Always. Kunal, hi, good morning. What a savage last week and the worst January that we've had so far.
Yeah, the worst week, one of the worst weeks for the markets. I think we started on a negative note on Monday, previous week, and we ended on a very, very pessimistic note. I think we were on the verge of breaking the 25,000 mark also on Friday. And, it's been a disappointing market breadth. It's been a disappointing series of data points. You're going into the end of the Jan series today on the fact, and especially with the fact that the budget is also in line. So there's too much at stake for the markets right now. Too much of dependency on data points, whether it's tariff, whether it's budget. But it's difficult to find that the markets, even at a point, being extremely oversold in terms of most of the technical indicators. We look at put call ratios, we look at RSIs, etc. The markets are completely oversold in that category. But even in an oversold market, there is no respite which is happening. The volatility is not dropping down. So yes, there have been good starts for the index, a 50-point, 100-point starts like what we are seeing today. But it's not converting itself into a decent bounce back for the indices. That's, I think, the most disappointing point. I was looking at the rollovers data also till Friday because I think most of the rollovers could probably have happened because of the short week. Even the data is not very, very encouraging because you're seeing some signs of short rollovers being carried forward for the February series. So I think this could probably be a phase where the markets could remain a little bit more turbulent. Hopefully, post-budget, if the market reaction is a little bit positive, that volatility will drop down. So at least you want the markets to drop down that volatility. You might not see a bounce back like a V-shaped recovery, but even if there's less ranged days for the markets, you see a 100-point range, 150-point range, largely with no major damage to the market breadth, that itself could be considered as a decent positive.
But right now, you don't have that conviction that the worst is over.
Not really, Aisha. In fact, the market breadth data is so disappointing. 86% of the stocks in the small cap index are below their 20-day moving averages. 70% from the Nifty mid-cap index are below their 50 and their 100-day moving averages. So that data is not encouraging at all. And so probably you would expect that the market being at such an oversold territory, you would expect some sort of a revival, but it's not seen across the board. No sector patterns. The only 2 or 3 major sectors, metals, banking to a larger extent, of course, being more dependent on the PSU banking names, and to some extent FMCG stocks, which are just holding their fort. I think if you take out these 3 sectors, you look at large cap names and the kind of selling which you've seen, it's very difficult to anticipate.
And you see the Nifty range now falling to 24,500 now, means if you look at it from that point of view?
See, I think it's a good question, Sajid, because over the last 1 month, we've just seen the markets adjusting 500-point ranges because of the damage to large cap names. Now, thankfully, no major large cap stocks are falling sharply. So, for example, HDFC Bank is now stuck at 920. Reliance is at sub 1400 levels, thereabouts. And you don't see too many large weighted stocks which are taking the beating. So, I would expect 25,000 to be the next pivot for the index. So, we should just hang around to that 25,000 mark, maybe plus minus 250 points.
Let's talk banks, because some of those numbers came out. They weren't particularly disappointing in any fashion. How do you look at them, and how should one look at the Nifty Bank? Because that was one of the key pressure points in the market. The IT index, in fact, held up fairly okay on Friday in relative terms. But the Nifty Bank was the pressure point. Can that be the trigger as well, looking at the way the Nifty Bank will move, which will largely drive the Nifty?
So I think within the banks also, Harsh, the bigger concern is the private sector banking names. You look at the PSU banking stocks performance broadly, 3 months, 4 months, 1 month, 1 week. They've been doing very well for themselves. So you might have 1 or 2 stocks like PNB, which has fallen down by 5-7%, but then you have other names like Bank of India, SBI, which are offsetting. But in the private sector banking names, there is no offsetting which is happening. If HDFC Bank is taking a beating, you have ICICI Bank to add to that salt to injury. So I think in that context, you don't see any major pickup in the private sector banking names. I, for one, believe that you need to see a cohesive move across private sector banking names, not one-off stocks which can probably try and do cartwheels. So I think over here, the private sector banking stocks in a definite zone of underperformance. Yes, they could be in a good value territory as a contra buy. But then whether these stocks would come back into a V-shaped recovery or they would time-wise consolidate, I think it's more latter.
So any stock ideas, Kunal? Shorting stocks further, or you think something is worth a buy?
No, so I think some things are definitely worth a buy. I think the FMCG stocks, like, for example, that's looking attractive. I would look at HUL as one of the strong candidates of a decent turnaround of sorts over here from the current levels. The stock trading at 2400 thereabouts, closing or inching very close towards the 200-day moving average. Looks extremely attractive on the short-term charts. 2500 as a near-term target is where I would peg the targets for HUL. Stop loss could be kept at 2370. And Hindustan Zinc has been one of the stocks which we've been recommending. I think it's now nearing closer to that 700 as a breakout point. So we'll look at a buy with a revised target of 716 for Hindustan Zinc. Stop loss to be kept at 690.
Okay.